Hi guys, I'm Ahana and welcome back to my channel. Now, in the last video I posted, I mentioned that I've been spending a lot of time lately on fundraising, and I realized to those of you who aren't really in the startup space, it may not be very obvious what fundraising is, as it's a pretty unique experience that founders go through. So I figured that in this video, I would try and break down fundraising for you, maybe demystify it in a way. And the way I'll be doing that in this video is by giving you an overview as to 1, why companies need to fundraise, 2, the different stages of funding, 3, the different types of investors, and 4, what this all actually means for a company and how do you go about it practically. Now, I have so many stories from my own fundraise, but I can't fit them into this video as well, so I'm going to try and keep this fairly objective, fairly neutral, and explain to you the process. And if you are interested in hearing sort of the behind the scenes, some of the crazy stories that have come from this experience, be sure to subscribe to my channel and I will be certainly sharing some of those stories in a later video. But without further ado, let's get into it. The first question is, why would a startup need to fundraise? Now, the simple reason is that sometimes you need to spend money before you can start the company. Let's take an extreme case. You want to build a rocket, and you are the top engineer, you are really well placed to do this, you know exactly how you're going to do it from your, let's say, your PhD. But how do you buy the materials for your rocket? You can't build the rocket alone, you need a team of people around you, but how do you pay them? How do you get them to leave their existing jobs? How do you pay yourself? How do you afford to leave your existing job? So once you start thinking about these sorts of questions, you realize that actually, sometimes it costs a lot of money to even just get started. So the rocket ship's a bit of an extreme example, but if we bring this to a very typical example, you know, you're launching a software company. Again, it boils down to, well, does the team have the skills needed? Can we get this to market soon enough? And if the answer is no, then oftentimes you have to put money into hiring a developer or growing the team to fill competencies that are missing. And all of this takes money. And if you aren't in a position where you've saved up to launch your own business, then what do? You might be the best placed person in the world to be solving your problem, but if you don't have that funding, how do you get started? And that's why companies fundraise. The alternative to fundraising is called bootstrapping. Now, bootstrapping is when you assemble a team with the core skills. Oftentimes, bootstrap companies will be doing a full-time job or studying at university and doing their startup on the side, and then at a later stage get funding. But they'll actually get to the point where they've developed their product themselves, they have users. Some bootstrap companies generate millions in revenue as well without needing that initial investment. In a way, that's better for the founder because it means that you retain more equity in your company. You don't have to give away shares in return for money. So when your company becomes the next billion-dollar company, rather than the investor having taken 20% at your seed round, you actually own that and you're that much wealthier. And so you're almost rewarded in a way for having those extra skills. Now, this is all in the startup context, but there's a key distinction between, let's say, a startup and a small business. Oftentimes with a small business, it doesn't necessarily scale in the same way that a startup does, but that's often also why you need less money to get them started. You know, let's say I'm really good at knitting and I want to start my own knitwear company. If I have a full-time job that's paying me, but I have some free time on my weekends, it's not super expensive to afford the equipment that I need to get my business going. I probably already have the equipment and can probably well afford it given the salary I have. So you can get started from day one and add value from day one. I can knit a jumper, I can find someone to sell it to, and I've already made money. It's unlikely that this small knitting business will go global very quickly, but once you do start growing, let's say your whole city wants to buy your knitwear, at that point, because you haven't invested really any money into the business, but you're already generating revenue, you can use that revenue to make more hires, get more people knitting on your team, maybe get a marketing person, put some money into Facebook ads to grow even more. But that's coming from your revenue rather than from venture investment. Okay, so now we've established why someone might need to fundraise, let's talk about the different stages of fundraising. Because a company that started 2 weeks ago is going to have different needs and different capital requirements than a company that's 50 years old. This is where different funding rounds come into it. Funding rounds have different names. So the very first round a company will ever do is called the pre-seed round. So pre-seed generally refers to companies that are pre-revenue, might not even have customers. Oftentimes it's just an idea, but it's a high potential team and they've done some initial validation on the idea. And in order to do that, they may need to get funding to even get that off the ground. And that's when a company will raise a pre-seed round. After the pre-seed, you have the seed, then the Series A, B, C, D. Once you get to sort of the Series D level, other options might present themselves, such as an IPO, an initial public offering, or a PE acquisition, being bought by a private equity firm. I will explain both of those, so don't worry if you don't know what they are. There are 3 key things that separate rounds from each other. So the first is the company valuation. Oftentimes, the earlier the company is, the lower the valuation is, and as they progress, they prove themselves more, their valuation increases. The second is the amount of capital you raise. So as your valuation grows, you tend to also need more money to grow even quicker. It's a compounding effect, so the amount you'll be looking to raise in different rounds will increase the further along you get. And the third thing that changes is the ownership that your investors have. For a pre-seed round or a seed round, most of the time your investors will not want board control. Your investors won't really be taking board seats because it's still early stage. It's up to you as the founders to prove that initial business idea, gain that initial traction. And only at a much later stage, once the company is much more established and requires more traditional business experience, does it make sense for investors to have board seats. And as with everything, there are exceptions. So some investors will take board seats really early if they're the absolute perfect investor with very honed in domain knowledge in the area that you're working in. They might ask for it and it might actually make sense for you as the company. But generally speaking, the amount of say an investor has increases the later you get. And early on, of course, your investors should be there for you. You should be able to go to them for advice. But technically, they can't really force you to make any decisions, and the company is really in your hands early on. The other thing to note there is, although the earlier investors won't officially have a say in the company, they tend to have a larger appetite for risk. Because the earlier you are, the less you've proven your idea, the less you've established yourself. So there's still a big chance that the company could fail, and after all, most startups do fail. But they've taken a bet on you and on the market and your plan going into that. So naturally, the types of people investing at your Series D when you're already generating millions every month in revenue is going to be different from those coming in at the pre-seed or the seed where you're probably still pre-revenue. And on that point, I'm going to segue into the different types of investors that are out there. So caveat, there are many different types. So in this video, I will just be going over the main ones that you may come across commonly. So when you just start your company, you just want to get your idea off the ground, most people will do what's called a friends and family round, where they go around to any friends or any family that might have some small savings that they can just help get the company started, maybe help the founder take that decision to quit their job and start going. These tend to be really small checks, not everyone will do them. In our case, we were students, so we didn't really have friends that we could ask for money when no one had any money, but that's often a way that especially more established people, or had I not got into YC, had I taken my banking job, maybe I could have saved up and actually invested my own money into the company as a way of getting it started. So these are the types of people that invest in a friends and family round. They're your friends and family. And these people only really come in at the very earliest of stages. What you might see after a friends and family round, once you've started working, is interest from angel investors. Now, angels are individuals, but you may not know them, you may not have had a personal relationship with them before, but they invest as an individual. So they might be someone who, maybe they had their own company and they sold it and they have a pot of money, they have enough to live on, and they just want to invest in the future. They want to make some early stage risky investments that could be really high return. So these are people that go out, and oftentimes if they have expertise in a certain area, they like to invest in a certain area where they know it really well. They like to meet you as the founder. You will give them a proper pitch, whereas with friends and family, it might be more casual. It might just be, a matter of asking them. With an angel, it's a little bit more formal. They are, at the end of the day, an investor who's doing this as financial investment. They're not doing it as a mate to help you out. Almost anyone can get into angel investing. I guess it's kind of similar to stock market investing. If you have some money saved up, you can get into it. It tends to be a little bit of work because you have to vet the companies, you have to understand markets in different areas, but some people find that really fulfilling and get into angel investing quite early. Another type of investor that's kind of similar to an angel is an angel syndicate. So an angel syndicate is a group of angels, a group of people who want to put their money into companies, but oftentimes you don't have the time to vet each and every company, meet with all of them, do your individual market research. So you join a syndicate where there's maybe somebody leading that syndicate. They are like the lead of this group of angels, and they are the ones that go out and do this due diligence. They speak with the founders, they source the new deals, then they share the opportunity with the group of people. And they may not have that much money. They may just love talking to startups and learning about them and wherever they can investing. But if they can, they would like to contribute more money, and they have friends or people in their networks who trust them and trust their investment decisions. So the way an angel syndicate works is you have somebody leading that, they do the due diligence, as I said, they're the ones who will advertise this deal, this opportunity to the rest of the people who have the money in that group, and then they will be the ones leading that investment. So rather than having a check from one person, you may get multiple people investing, which is a benefit to the founder because it might have been the same number of meetings to you, but more people are coming in and investing. The downside of a syndicate is that it takes more time to coordinate more people, and if your round is moving very quickly or the terms are constantly changing, then a syndicate might be a little slow. And also syndicates can be quite prone to FOMO. When it's a one-on-one conversation, if someone just really likes you, there's a chance that they invest. It's harder to build that relationship when you don't meet someone, and as such, they may be more influenced by factors like other investors coming in or a big name investor coming in, rather than you as the actual company. So strategically, founders will often speak to angel syndicates as they are closing their round, rather than to begin with. Now, the last early stage type of investor that I'll be talking about is a VC, or a venture capital fund. Now, these are companies that strategically invest in the early stage. So they have stakeholders, they have to fundraise themselves to get a pool of money that they then scout startups, but unlike an angel who might be doing this as a side hustle or just for the fun of it, this is their full-time job. And oftentimes people who work in VC have started their careers in places like investment banking, where you get really good at analyzing later stage companies, but you want a bit more fun and excitement, and you get that with early stage. And as such, you transition that way. Or another common route into VC is actually being a founder yourself. You understand the challenges, you tend to have a good eye for what works and what doesn't, and that makes you a really strong VC investor, because then when you're talking to companies, you can make better decisions, and then your investors as the fund will get a better return because you're making good investment decisions. So the way these funds make money is by making good investments. And it's worth noting that the way that all of the people that I've talked about up till this point invest is they give you cash. So they will transfer money into your bank account in return for a percentage of your company, and that's known as equity. The technical ways of issuing that differ based on a couple of technicalities, such as where you're located. In our case, the investment vehicle is something called a SAFE, but I won't bore you with the details. All you need to know is that it's pretty straightforward. There are easy ways of doing equity investments. Now, another form of financing is called debt financing. So we have equity financing, debt financing. Debt financing often will happen at a much later stage than equity financing, and the people that do debt financing are the private equity firms. So the way this works is that these firms will tend to come in at a much later stage, but the reason that you may want to invest with some debt is because it actually amplifies your return as the investor. Now, if you're not interested in the technical spiel that I'm about to go into, feel free to skip this section of the video. But for those of you who want to understand how a private equity investment works, let me lay it out for you. So when a PE firm buys a company, it's what's called a leveraged buyout, and leverage is the same thing as debt. So the private equity fund takes out a loan. They'll take that from a bank. So they may go to an investment bank, they'll say, look, we want to do a leveraged buyout, we need a loan. So they take out a loan from the bank, but just in the same way as if you have a student loan or if you have a mortgage, you have to pay interest on that loan. So you have to pay it back and a little bit more. So the PE firms do have to pay that money back to the bank with interest. However, a private equity firm tends to make investments in later stage companies that are already generating revenue. So what they do is they take this revenue that the company is generating to pay off that loan. And the reason for doing this is by investing with a combination of debt and equity, you amplify the returns. Now that might not be super obvious, so let me give you an example with some numbers. All right, let's take the example of Quill. That was the name of our first company. Now, Quill's not a great company. It's worth only $100 in 2021. This year, the PE fund wants to buy it and its value is $100. If they pay $100, they buy the whole company. When a PE firm buys a company, their goal is to make that company worth more in an exit window, and that's often 3 to 5 years. So let's go with 5 years. In 5 years' time, this company will have made changes to the management, they would have got a really good team of people in, they may have changed the business model, they may have improved some inefficiencies, and made it an overall better business so that its value is worth more in that 5-year period. So they bought the company, they bought Quill in 2021, and it's worth $100 But in 2026, 5 years later, it's actually now worth $200 because of all these amazing changes that they've made. They've doubled the company's value. Now, in 2021, when the PE firm wanted to buy Quill and it was worth $100, had they done an equity-only transaction, had they given $100 of cash straight up to the company and then exited 5 years later at a $200 valuation, that's a 2x return. So 200 divided by 100 is 2. So they doubled their money, which isn't bad. And that's the premise of how VC funds will invest. It's pretty good, but when you invest earlier, the returns are higher, so it works out for them. But if you're a PE fund, you're investing in later stage companies, they're not going to double their value. They're not going to 100x your return like a super early stage high growth startup would. So how do these guys make their money? Well, rather than paying $100, rather than paying the whole value upfront in cash, they will pay, let's say, 50% of it with cash. So they'll give the company $50 of cash, and then the other $50 will come from the debt financing. So that will come from the loan that they've taken out. So the private equity firm will go to the bank and say, hey, can I have $50 so that I can make this investment? And they will give that $50 to the company. So even though they have to pay interest on that loan, that's being paid off by the revenue that this company that they've acquired is generating. So it's almost not really even a cost to them. They don't have to pay it out of their own pocket because it's coming from the company. But when the company exits, you've paid off that $50 loan that you've taken. You only put $50 of your own cash in. But now the company is still worth that $200 that we said. They've made the same changes. They've done everything else the same. They've taken the value from 100 to 200. But because they only put $50 in the first place, that's a 4x return. So you've multiplied your returns by just financing it with debt. So that's the premise of how private equity firms fund companies, and that's why that tends to happen at a much later stage. And again, the types of people that you find in private equity tend to be bankers or consultants who are just really good at analyzing companies, but rather than VC investors, you don't see as many founders, as later stage companies are just by definition more mature. So they're slightly more predictable, there's less uncertainty, which if you're the type of investor that likes mature companies and really cares about optimization and strategy, then that can be a fantastic place for you to work in, which is why it attracts so many bankers and consultants. However, for VC investing, you need to have an eye for a vision and an idea, which does take a little bit of a different skill set, but you do still need that basic financial knowledge that you would also get from a career in banking, for example. A quick point, I just said that the private equity firm might want to sell the company at 200. The question then is, well, who are they selling it to? Who's buying this new company that's been made better but is now at a higher value? There's a couple of different things that can happen, but I'll go over two common things that tend to happen. So the first is that it IPOs. So they sell shares to the stock market, and that's how they get their return. That's how they get their money that they invested back. Or another option is a re-LBO might happen. So one PE firm might sell the company that they've acquired to another PE firm, and then the cycle continues all over again. This is all very technical, and I'm sorry if I bored you with that section, but I'm now going to chat a bit about what that means for us as a company, as founders fundraising. If you're raising your seed round, or you're at an early stage like us, where you have a product, you have users, but you're not generating large amounts of revenue and you're not a very mature company, you haven't been around that long, the way you'll do it is you tend to create a pitch deck of slides that will explain what your company does, who the team behind it is, how you make money, what your long-term vision is, and really just give someone that knows nothing about your company a good overview of what you do and who you are. You then need to find investors. You need to get people excited about what you're building and get meetings with them so you can take them through your pitch deck and tell them your story. And you finish up by basically saying how much you want to raise, what valuation you're at, and how much money you'd like from that investor, or you can ask them how much they typically invest. So you need to get those meetings in the first place, and there's a couple of different ways you can do it. The first is through accelerator programs. So Y Combinator, for example, was a great source of investor leads for us because investors, it's their job to know which companies are up and coming and exciting. And so they look through the list of companies that have been accepted to YC, and it's the same for other accelerator programs as well. Being in an accelerator will inherently give you some name and start to get people talking about you and knowing who you are. It'll put you on the radar. And the second benefit of an accelerator is a demo day. So YC had their demo day where they actually invite investors. So it's not just a word of mouth thing. They categorically will invite the investor to watch the company's pitch, and then from there an investor might be interested in you and you can set up that meeting to take them through your pitch. And when it comes down to actually giving this pitch, it's a pretty stylistic point. Some founders like to go through every slide of their pitch deck and keep it very structured and then leave time at the end for questions. Some founders don't like to use their pitch deck and just tell a story and keep it really conversational. Other founders will do sort of a hybrid method with both, but it's really up to you how you want to run your investor meetings, which is why oftentimes founders will practice pitch with other founders and kind of get a sense for what works for them and what really highlights the best aspects of them as a founder and of their company. And if you're wondering about like the form factor and what this looks like, the meetings on average go for 30 minutes. The way I like to do them is really just start by asking the investor a little bit about themselves and actually delving in there. So not getting just the high level like 2-second intro. I like to really understand why they do what they do. What type of an investor are they? What sort of background do they have? And sometimes I'll even ask them how much they know about skincare. And the reason I do this is because it can help me tailor my conversation. If I know that they have, let's say, a banking background, well, I can relate to that. There's something in common, I know to touch on that. Or if they know nothing about skincare, which has happened, you know then how to convey your idea, because for someone who is a skincare enthusiast and lives, eats, breathes, sleeps skincare, the way I'm going to tell my story will be different from someone who doesn't know what skincare is. So it just helps me assess what story I tell, how I present the pitch, and it also shows a little bit of engagement. Based on the type of investor, there's different processes. So if they're an angel, they might commit in the meeting itself. That has happened, where the person's been like, okay, cool, yeah, I'll put in a 10K check, for example. The other option that's more common with VC funds and also with some angels is that they say, okay, great, thanks for the meeting. I need to go home, review the pitch deck, and I'll come back to you with a couple of questions or a follow-up meeting. And then they get back to the founders with either, okay, let's have another meeting, or sometimes they decide to invest already, or they will pass on you and they will send you an email explaining why they've passed. Sometimes they are truthful, sometimes they're not. Oftentimes investors that pass will still want to be kept in the loop with you, especially if you're an early stage founder and you got along well. They don't want to close off that relationship. So they tend to be pretty nice about it, which is nice. But it can also not be that helpful to the founder because you might not really know the reason that that investor hasn't invested, which makes it harder for you to iterate and improve. Okay, so now you know what I've been up to for the last 3 months. It has been that. It has been a series of finding investors, talking to them, convincing them, all different types of investors, different types of people with different backgrounds, and it's quite an experience. You know, a lot of people told me that fundraising was hard. And I agree. I think this has been one of the hardest parts of being a startup founder. And don't get me wrong, I love my job and I love the fact that I even get the opportunity to talk to some of the investors that I have, and I've really grown my network and made a name for myself in this community, which at the end of the day, whether an investor passes or not, I've been given the opportunity to start making a name for myself as a founder at the age of 22. And inevitably that will make it easier in future rounds to get the interest of investors because they know me, I've built up that relationship and I have that track record with them. So fundraising is really a place of learning. I think also as a founder, it can be quite an emotional experience. When you put it into perspective, I was doing around 10 meetings a day. Now that's like doing 10 job interviews. You know, you pitch them, it is kind of like Dragon's Den. So you're getting grilled for 30 minutes, 10 times a day, and then you wake up and you only really need like a couple of acceptances. You only need a couple of people to say yes and you've closed your round. But inevitably that means you're going to get a lot of no's in the process. So it's just like doing all of these pitches, you have to give the same energy. You wake up in the morning to emails saying investors are passing. They may not give you a reason, or they may give you a reason that just doesn't really resonate with you or make much sense. And you have to pick yourself up and do it again and again and again, which is why it can be hard. For a standard person, if you apply to a job or you apply to a university and you get one rejection, it feels bad, no one likes it. But you get over it and you move on, but it still hurts. This is kind of like that, but just accelerated, because rather than one rejection and doing maybe one job interview a week, you're doing 10 a day. And you're getting multiple rejections a day. And so it is a really intense experience, but at the same time, it also all blurs into one. And I really think that for the founder fundraising, it's all about the mental state you're in and how you view the experience. Some founders will close their round in a matter of days. If you're a hot company in a hot area, something that's trendy or something that's cool, and you have tremendous traction, or a really superstar founding team with a great track record of being superstar founders in the past, it can be pretty easy for you, and some founders are just exceptional at fundraising. But for the vast majority of founders who don't have that and are just people like you and me trying to build companies because it's what we love, it can be hard. And I think that the lessons that you learn from fundraising are some of the hardest. They're the least nice to swallow, but they make a huge difference in you as a character and the resilience that you build up. But I will be touching on those stories in a future video. That's all for this one. Thank you so much for watching. I know there was a lot of information, but I hope this helped you if you just wanted to get an overview of what fundraising was like. And I hope you stick around on my channel to see more videos in the future going into some of the personal experiences I had and some of the learnings I had from the experience, because I made so many mistakes going into the fundraise. Like, I can't even begin to tell you all the things I did wrong. So I'll save that for another video, but otherwise, thanks again for watching, and I will see you in the next one.